Hey guys, today we're talking about another EV stock. The company name is Volta Charging Industries. I decided to go ahead and look on this company and dig in deeper because I see there is something different about their business model, and I always like to look and find for creative business model, especially when it comes to electric vehicle companies. So the video format will go like that. First, I'm going to introduce the company. I will explain how the business model works. Then we will talk about some financial data I think worth mentioning. And lastly, I'm going to get to a conclusion and we're going to talk about the valuation of the company. Now, as always, the video is for entertainment purposes. Don't take it as an advice and always do your research. So Volta Charging Industries provide chargers for electric vehicles while combining the charging stations with advertisement. And they are about to go public through a reverse merger that will be performed by the SPAC company. At the moment, the ticker symbol is SNPR and they are traded at around $10 per share. The ticker symbol will change to VLTA when they are going to become New York Exchange listed company, which means when they're going to get public, the ticker is going to be VLTA. So basically the stations look like that. Those are the stations. They have three types. Each one of them has a different specs. This one charges up to 30 miles per hour, and this one, for example, charges up to 250 to 400 miles per hour. Now, as you can see over here, there is an option to put advertisement, and the advertiser can be any company that just wants to use ads. Now, let's go through the business model. So we said the company provides charging services for electric vehicle owners, and they combine that with advertisement. So it goes like that. They're going to find site partners. It can be any store owner, any real estate owner that want to partner with the company and let him install some stations near his property. Each time a person comes and charges electric vehicle using Volta's chargers, Volta will earn money. On top of that, every company that want to advertise can sign with Volta. And over here there are many options of how the advertisement is going to look like, and it actually looks really nice. So what we see over here is the cumulative cash flow per station, which means we can see over here the lifetime since day one that the station was installed until 10 years from that period, and what should be the recurring cash flow from each station. Now, as you can see, there is two types. There is current L2 and current DCFC, which is two type of stations. Each one of them has different type of cost. It looks like it costs them between $50 to maybe $75,000 to install one. And now you can see over here that it takes around 3 years to break even, which means in 3 years, around 3 years, they expect that each one of the stations will manage to generate cash that will cover the expense they need to make at day one when they install the station. Now, of course, they say that as the business will grow and they will install more stations, the cumulative cash flow per station will grow, which means if we'll go one slide below, over here they represent a much higher return on investment because they're talking about an expectation how it's going to look like at 2025. So they say for each station they will need to invest less, and it's going to take only 1 year to return the investment, and the cumulative cash flow per station is going to grow much faster, resulting higher amounts of cash flow at the business. But those are just expectations. The top slide based on historical performance, so we can trust this base slide. All those companies that provide charging services are going to compete with each other, and I think it's important that Volta has something different because we can't really know who will be better than other. At the end of the day, everyone provides electricity and it's all about location. But when it comes to advertisement, it tells me that even if they won't manage to get as much chargers and as much charging persons on their stations, as long as they get good locations with high quality customers that spend money, they will manage to leverage their advertisement business model, and I think that's important. Now, at the moment they have installed 1,500 stations as for 2020, and accordingly to what they represent over here, the expectations until 2021 is 3,100 stations. When it comes to revenue, the expectations is for $47 million as for 2021, and for 2022 is $150 million. I don't know how much we can trust 2022 and the years after, because it happens a lot, definitely with those SPAC companies, that they say one thing and then couple months later the guidance will change. This investor presentation represents expectation. Now, as you can see over here, when they're going to be public, they're going to have expected to have cash on hand of $660 million. On top of that, they will have debt they will need to pay of $52 million before investment, pre-money equity value of $1,300 million, and after the investment, their value will be $2 billion. They're expected to go public around June, and that should be their market value, around $2 billion. It might change, but as for this moment, that's the value. Now, as you can see over here, they're expecting to have 40% gross margin, and it's expected to grow year over year. Now, that's super important because the higher the margins are, the more cash they're going to have available to fund their operating expenses and other cash requirements. And if we're talking about cash requirements, we can assume that it will be around $130 million for 2021, and I got to that number by combining the operating expenses with capital expenditures. Of course, that's not an exact number, but we can use it for the estimation. And next year, if we're gonna sum operating expenses and capex for 2022, they're going to burn around 230 million cash next year. It's important to understand how much cash they burn in a year, so we can understand if and when they will need to sell more equity or borrow more money. If they have $600 million cash on hand, it doesn't look like to me that they will need to get additional funds in 2021 and 2022. The simplest way to evaluate a new EV startup is to use multiplies. That comes instead of trying to come up with a future cash flow projection and a reasonable discount rate that will lead us to the sum of the present value of future cash flows, which basically at the end give us the present value of the company's equity, or in simple words, their value. So instead of using their future cash flows, I'm just using multiplies. And I have noticed that new companies in the EV sector that I consider them not expensive or some kind even mediocre when it comes to their valuation, they are priced of around 20 times their trailing 12-month expected revenue. Now, I think it's going to be fair to combine revenue for 2021, 2022 and divide it by 2 to get an average revenue for the next trailing 12 months, and that's going to be around $100 million. My bottom line is I think a fair value for them should be around $2 billion, and that's exactly the price which they are going to get public at. Now, of course, just an estimation, it can be higher or lower, and at the moment I'm not investing in this company because I don't like the valuation. But there is one piece of information that is still not complete for me to really get a decision, so I'm still thinking about it, and that's the advertisement business model. I'm still trying to think how much of revenue they are going to generate from advertisement and how much of revenue they are going to get from charging. But at the moment, I'm not doing anything, still looking at this company until I'm going to get a conclusion. Thank you for joining me. I'm going to see you in the next video.